The generally accepted accounting principles, or GAAP, are general rules that apply to the field of accounting. GAAP consists of three sets of rules. 1. The basic accounting principles and guidelines. 2. The rules and standards issued by the Financial Accounting Standards Board. 3. The generally accepted industry practices. These rules and guidelines come into play when a company displays its financial records to the public. If a company's stock is publicly traded, it is required by federal law to be audited by public accountants. GAAP is used to standardize and regulate. This is done because it shows consistency year to year and is assumed in order to determine growth or loss between years. In this video, I'll go over 5 basic accounting principles and guidelines. The first is the continuing concern principle. This principle assumes that a company will continue to exist long enough to carry out its objectives and commitments and will remain in business for the foreseeable future. If the company's financial situation is bad enough that the accountant believes the company will not be able to continue on, the accountant is required to disclose this information. Next is the business entity assumption. This rule states that the accountant must keep all of the business transactions of a company separate from the business owner's personal transactions. For legal purposes, a company and its owner are considered to be one entity, but for accounting purposes, they are considered to be two separate entities. Next is the cost principle. This accounting principle states that asset amounts are not adjusted upward for inflation. Assets are recorded at the cash amount at the time purchased and are not adjusted to reflect any type of increase in value. Therefore, an asset amount does not reflect the amount of money a company would receive if it were to sell the asset at today's market value. Time period principle. The time period principle is the concept that a business should report the financial results of its activities over a standard period of time, which is usually monthly, quarterly, or annually. Once the time period is decided, it must be included in the header of a financial statement. Lastly, revenue recognition principle. In actual basis of accounting, revenues are recognized as soon as a product has been sold or a service has been performed, regardless of when the money is actually received. In cash accounting, revenues are recognized when cash is received, no matter when goods or services are sold. Under the basic accounting principle, a company could earn and report $20,000 of revenue in its first month of operation, but receive $0 in actual cash in that month. The basic accounting principles and guidelines includes many more rules and principles, including principle of conservatism, matching principle, materiality principle, full disclosure principle, objectivity principle, consistency principle, and many more.